The balance sheet. What is the balance sheet? The balance sheet is a financial snapshot of the company's financial condition. It lists the assets, liabilities, and owner's equity, which is also referred to as shareholders' equity in a corporation. The balance sheet is unique from the other three financial statements because it shows the condition of the company at a specific date. The other three financial statements only list financial data for a specific period of time. Assets. Assets are defined as anything that will provide an economic benefit in the future that has resulted from a past event or transaction. Basically, an asset is anything the company owns that has value. There are two forms of assets: current assets and fixed assets. Current assets is anything that has a useful life of less than a year. Current assets are inventories, goods and materials used to sell to customers to generate profits. Accounts receivable, money that is owed to a company from selling past goods and services on credit. Cash, the currency. Cash equivalents, assets that are easily converted to cash, such as money market funds, short-term government bonds, treasury bills, and certificate of deposit. Fixed assets, or non-current assets, is any asset that is not easily converted into cash. Fixed assets include buildings, land, vehicles, furniture, and machinery. Fixed assets are also classified as either tangible or intangible assets. A tangible asset is anything that you can physically touch. An intangible asset is anything that you can't physically touch, such as copyrights or patents. Liabilities. Liabilities are defined as anything that you are legally liable to pay for, such as debts. Liabilities are classified as either current or long-term liabilities. A current liability is a debt that must be repaid within a year. An example of a current liability would be supplies that were purchased from a supplier, which are known as accounts payable. Other examples include wages and taxes. If the liability is not due within 1 year, the liability would be classified as a long-term liability. Examples of long-term liabilities are pensions, long-term leases, notes payable, and long-term bonds. Owner's equity. Owner's equity is the value of the assets after all the liabilities are paid off. Owner's equity in a corporation is referred to as shareholders' equity, since the owners of the corporation are millions of shareholders. If there are more liabilities than assets, then the shareholders' equity is negative, which would be a bad thing as far as the shareholders' interest. This balance can be represented in a special representation called the accounting equation, which states assets equals liabilities plus owner's equity. The basis for this equation is that no matter what action is taken in the corporation, the equation must always balance out. If assets increase by $400, then there must be a $400 increase to liabilities or shareholders' equity. Liquidity. Liquidity is defined as the ability to quickly turn an asset into cash without significant loss of value. A stock is a rather liquid asset because you can easily sell the stock at fair market value within a day. Compare that to an illiquid asset, such as a house. To sell the house would require a very lengthy selling process, and could take months to complete the selling process. It is important to note that the balance sheet's assets are listed based on liquidity. Notice the order of the assets in the balance sheet below. Liquidity in a corporation is important because the more liquid a corporation is, the better they are at paying debts when they come due or purchasing inventory in a rapid manner. The disadvantage of having a very liquid business is that liquid assets often don't return a good return. For example, cash will only return the interest rate of the account it is being held in, which is often very low compared to other investments. Liquidity versus profitability is a key concept to corporate financial planning. Net working capital. Net working capital is defined as current assets minus current liabilities. A positive net working capital number means that the firm is liquid and should be able to pay its debts as they come due. Remember, current assets and current liabilities are limited to 12-month periods. For example, consider a firm purchases inventory on account and charges the cost of the inventory to an account payable. As the firm sells the inventory, it will repay back the account payable. The firm can also sell to customers and create accounts receivable, which means the customer will repay at a later date. As the customers repay their accounts payable, you will receive cash, which you use to pay off your accounts payable. If the net working capital number is negative, then it means your current liabilities are greater than your current assets, which means you will eventually run out of cash and have liquidity problems. Book value. Book value of assets is the value of the assets according to the balance on the balance sheet. The book value of the assets does not account for the market value of the assets, because all U.S. corporations must comply with general accounting principles. The reason the assets are not valued at market value is because GAAP regulations state that assets must be valued according to historical cost. Historical cost is what the corporation paid for the asset, or its acquisition cost. For example, a corporation purchases a parcel of land for $100,000 in 1995. The corporation places the land at $100,000 in its books. In 2005, the land was valued at $250,000. The corporation does not change the $100,000 original cost, because the $100,000 is the book value of the asset, whereas $250,000 is the market value. Market value. Market value is defined as the amount at which the asset would sell for on the open market. The main reason market value and book value is important is because gains and losses are presented differently in each situation. A change in book value results from the accounting rules being changed, whereas the market value only fluctuates based on the supply and demand of the asset. Market value presents a more realistic valuation of the assets. However, book value is more useful when trying to value companies over long periods of time.